welcome back. I won't use the word exclusive because that's kind of kitschy, but we've got some serious fist pumping going on because we've got Tobias Levkovich with us today. I almost want to say he needs no introduction. He's been Citi's Chief US Equity Strategist for 20 years. Just had your 20-year anniversary, but I can't thank you enough for sitting down with me today. Welcome.
Thank you very much, Danielle. It's great to be here.
I've only known you since 2005. When I joined the Fed, I've never asked you where you grew up.
I grew up in Montreal, Canada.
Uh-huh.
My parents actually lived in South America and moved about 2 years to Montreal before. So my brother and sister are Colombian and I'm Canadian. So I always joke around and said I'm like the most nonpartisan person because I don't vote Republican or Democrat. I don't vote, period.
Love that.
Gets me out of jury duty, though.
So you attended university in Montreal as well.
I attended Concordia University in Montreal, which was one of the two English language universities because Montreal's half French, half English. When I grew up, now it's about 60% French, 40% English.
So presumably you speak French.
I do, vraiment, if you prefer that way.
I had my bachelorette party in Montreal.
I've been to a number of bachelor parties in Montreal, but let's stop there.
Yeah, we'll end it there. Let's just say that I thought it was a cute city in Canada until I had my bachelorette party there. In any event, we'll move on.
Let's put it this way. In Canada, we have Toronto the good, and as I refer to it as Montreal the naughty.
Yeah, it would make people in Vegas blush. But so recently...
I'm very proud to be Montrealer.
Yeah, I'll tell you a funny story about the little French I know saving me one night in Montreal when it was sleeting.
Well, no is no in English or in French.
Exactly. And my 7 years of French came in handy finally. So I have to say, I'm not used to picking up the Financial Times and seeing your byline. I was kind of floored. And then the title is The Worrisome 1999 Vibe to Markets. I mean, you've been on the right side of being bullish for a very long time, to the credit of everybody who's fortunate enough to read your research and see your views. Why do you feel like it's 1999 again?
So we're looking at our sentiment factors in particular. We have something we call our panic euphoria model. There are 9 factors in that model that kind of interact together. We had done this testing when I moved into strategy role back in 2001. The one thing we felt we were really missing was kind of a good sentiment gauge.
So you created the panic euphoria model.
We took something that existed and we kind of modified it.
Okay.
But we backtested about 70 different inputs that you could look at to see if they had predictive power. Mm-hmm. So for example, everybody talks about the volatility index or the VIX. Mm-hmm. It's a coincident indicator. It's not much of a predictive indicator.
Interesting.
Now, people say when it's sitting really high, it's predictive. When it's sitting really low, it's predictive too. Similarly, if you're between 10 and 20 on the VIX and you're between 30 and 40 on the VIX, your probability outcomes for success in markets are about the same. And everybody thinks they're wildly different. Where you don't want to be is between 20 and 30. That's kind of the ugly spot. Mm-hmm. But either if you're coming from high degrees of volatility or low degrees of volatility, once you cross that 20 or 30 threshold, depending upon the direction, that's not a good place to be. So in general, though, we backtested 70 factors, found 20 that had predictive powers, and then we started doing things like permutations, combinations, because often things can interact, because that's the real world, right? We don't live in a world where, if A occurred, B follows. But we do live in a world of A, B, C, D, E, F, and G are there. H is probably the next letter, right? The pattern is telling you something. So we started doing a lot of work, and give you an example. 2 of the factors in the model are short interest and margin debt. So if you have high degrees of margin debt, people are borrowing a lot of money to buy stocks. Usually a contrarian indicator, people are a little too bullish. If you have high short interest, they're essentially betting the markets will go down.
Right.
So again, contrarian indicator, if they have to cover their shorts, the stocks are going to go up. What happens when you have both margin debt and short interest up at high levels? Well, that's the signal you're getting going 2 different directions. So what I have found over my years on the street, and over kind of 35 years, that people have narratives and they just remove the one that doesn't fit the narrative, right? You look for confirming evidence because none of us want to deal with what my psychology professors years ago told me was cognitive dissonance. So we just get rid of it and we just go with our story. We don't really want that. We want what's really going on happening, telling us what the sentiment is, and then we'll build the narrative, not the other way around.
Sure.
So
follow the data.
So panic euphoria is in euphoric territory. The last time it was this high was back in 1999 into 2000.
Okay.
And the last time that it didn't signal a shorter term pullback was again in 1999 into 2000. So we've gone for 6 months in euphoria. We were at levels in February and March that were above what we even saw in the peak of the tech bubble. So these are the things that are getting us a bit nervous. Now, it's different. I need to be very careful, even though I'm more cautious than others. I'm not terribly bearish. In fact, I was telling a media outlet that they sound bearish, and I said, well, if you guys can feel terribly convinced of calling or designating me, tagging me a bear, at least call me a teddy bear. At least I'll be lovable, right? Because we think it's kind of more of a 10% pullback kind of thing, not a 20, 30 type percent pullback. It's not going to be 1999, 2000, leading into 2001, 2002.
Right.
Because of three things. One, we're exiting a recession, we're not entering one.
Mm-hmm.
Okay. Two, the Fed was raising rates for 15 months into March of 2000 before we started to see the market crack. Fed hasn't raised anything. If anything, they're telling you that, no, we're not going to. We'll see how it really plays out. But and the third one is, today, a lot of those big mega cap stocks that we talk about tend to be dominant market positions generating lots and lots of free cash. Mm-hmm. In 1990 and 2000, these are dot-com burning cash, trying to get first mover advantage.
Right.
So as soon as the cash dried up, so did their business plans.
Mm-hmm.
So we don't have the same constituency and framework that we have. But again, it doesn't preclude you can't pull back. It's just you're unlikely to have the kind of really bear market environment.
Well, the NASDAQ, I think, is down around 6%, maybe, I want to say. And that's been pretty painful for a lot of people.
So it's been painful in specific areas. Like, for example, you can look at stocks that are down 30, 40% within NASDAQ. And they tend to be more in the small mid-cap software stocks. They were trading 20 times revenues already. They were given like every piece of credit possible for their valuations. Mm-hmm. And to some degree, when we had COVID hit, we had this reaction in terms of shelter in place, work from home, and it benefited a number of companies' business models significantly.
Sure.
So their business really took off. And as the stock prices were reflecting that, more people came and said, these stock prices are going up. We've got to buy them because they're going higher.
Momentum. And
price momentum begets more price momentum. People come in, they're going to sell it to somebody who'll pay them even more in the future. And that's what they kind of believe. So these stocks probably went too far. Mm-hmm. And now we're coming back to earth.
So I'm curious. Now, so short interest, margin debt, what are the other seven?
You're going to test me remembering them all.
Kind of a cliffhanger here.
So oil prices are one, because they tend to have some interesting impacts on markets. Actually, gasoline prices specifically. We have the put-call ratio. We have the average of investors' intelligence in the American Association of Individual Investor Bullishness. So we do have one real pure sentiment metric in there. We look at the premiums that people pay for puts versus calls. How deep in your pocket are you willing to dig to buy protection? It's a kind of, if you want to call it, it's a tell.
Yeah.
Right? If you're really, really concerned about something, if you're not concerned about crime, you're never locking your doors. But if you are concerned about crime, you're going to lock your doors with 16 locks. You're going to get an alarm system, cameras, all that kind of stuff. So It's a question of what investment are you willing to put in if you're really, really worried in terms of that premium for a put versus a call. We look at money market fund levels. So what's cash on the sidelines, if you want to call it that, is another indicator. And I'm trying to think if I've said them all at this point. New York Stock Exchange trading volume relative to NASDAQ trading volume. So if there's more speculative trading in the NASDAQ, you can also pick it up through that activity.
Interesting.
I think I got them all, but if I missed one, I apologize.
No. I think you did as well. We have seen an appreciable uptick in options activity. Headed into Volmageddon and Powell's first days in office, and when a short volatility fund basically went away, ETF, there really wasn't that much retail participation in the market. Mm-hmm. That's changed.
So look, there was some of it related to the pandemic and stimulus checks. and people couldn't go into the sports betting sites.
Yeah.
There wasn't sports.
Right.
So I guess you could potentially have, gone into something on a cricket match in Pakistan or something. But I mean, generally speaking, there wasn't, the activity. So people, like the David Portnoys of the world, who were saying, hey, get in on this. And people were sitting at home, and it gave them something to do. That's very different today. But I think that kind of started some of that fairly inexperienced retail participation. And
that was very diplomatic.
And look, I still remember doing an options trade many, many years ago in my early days as an analyst, and ended up really working out. It was a short on a computer stock, and it worked out really well. And my boss came in the next day because he saw the trading sheets, and he said, hey, I want you to join OA from now on. And I go, OA? He goes, yeah, Options Anonymous. You're going to lose money doing this. And of course, I said, what does he know? He's an old dude, and he was right. I lost money on my next two option trades. So I've kind of personally sworn off them, but I, you learn through experience. That's
I was about to say that suggests that this very young generation of investors is going to kind of learn on the job.
We all do, in any job we do. There's on the job training, and some of that tends to be pretty painful.
Right.
So I do worry about people going into areas they don't really understand, and if they have quote unquote beginner's luck, they then believe it's their smarts. Right? Everybody's a genius in a bull market. Not so many when the tide goes out and you see who's swimming, naked. So those kind of things worry me a little bit. I don't think it's as bad as some people suggest. We've seen it in some areas, meme stocks, for example.
Sure.
And again, you're looking at companies that have real issues, and you got some, in my opinion, some manipulative activity that could be exacerbated. When I think of back, you're talking about the bubble days, right? Back in 1999, 2000, we had chat rooms where people did things. Now it's on, it's on steroids because you can do it in social media across millions of people. And people get caught up in this because they get excited by it, and they make a little bit of money, and they get even more excited. So things like small lot, option trading is a little bit disconcerting, but it's just another reflection of money trying to find a place to go, and they don't like earning 10 basis points in the bank.
Did we, remind me, did we have cult figures back in 1999 the way we do today? I mean, it seems like there's kind of this worship element.
There were, but the cult figures were generally running the companies. So a lot of these .coms, that were exciting, and we everybody knew Pets.com and names like that. And we knew who they were, and we could argue we have some cult figures today as well in corporate world.
Sure. So we keep reading about the semiconductor shortage. I mean, every other headline's about the semiconductor shortage in the auto industry and the effect it's having, global supply chain disruptions, and can't get production up high enough. But you recently made a fairly controversial call on the semi sector.
So we downgraded them back on April 9th. And our reasons were earnings revision momentum was really, really good and probably couldn't get much better. 90% of all estimates up to the upside. History says that doesn't sustain itself eventually. It can still go down to 80, 70%. Still, the majority of revisions are positive.
Right.
But it's a negative delta. In other words, you went from up 90 and it's only up 80, so that means it's 10% worse. And markets care about the rate of change as well.
Right.
So that was one of the reasons. Our valuation work also was suggesting that we need to pull back on them. We'd been overweight them. They were great stocks. They outperformed meaningfully. Anyway, something like 2,600 basis points in the prior year. So they were great. They rewarded us handsomely. But our valuation metrics don't look at it as a cheap relative to history or things like that. It's more of if the stock was trading, let's say, at an EV/EBITDA of 8, did the stock go up or down thereafter? If it went to 9, did it go up or down thereafter? If the PE was 25 and it went up, then it's not expensive. It's just telling us the stocks are poised to generate returns. So we have models that we've looked at on every single industry group, which have been the 5 or 6 most predictive. And then we build the model of those. And right now you're sitting at an elevated position, intimating underperformance. So we're saying, okay, look, let's count some of our chips.
Yeah, let's take some money off the table. Sure.
I'm making more fun of the chips term of semiconductors.
And I'm being obtuse.
And no, you're thinking gambling terminology, and I'm not allowed to talk about that.
So talk to me about the shift in the last 20 years towards really passive forms of investing versus active investing. And then what role has the 401k played?
So 2 ways of thinking about it. number one, there's nothing wrong with passive investment vehicles. I tell my children for their 401ks do that. Don't sit there trying to pick stocks. It's not something you can do as a part-time job, right?
True.
I use a different reference point, which is if the tile falls off my roof, I could go up on that roof and take a hammer and nail knock in the tile. But if I fall off the roof because I'm not really adept at doing this, I could break my neck, right? So the risk reward doesn't make sense. Pay the guy $100, to do it for you. And similarly, I think people work really, really hard for their money during the day, and they shouldn't be sitting there at 8, 9 o'clock in the evening and say, okay, I'll do some web searches and I'll risk my hard-earned money.
Right.
So for them, I think generally speaking, passive products like ETFs make a fair amount of sense. I use them when I go international because I can't do the work on, what's happening in Thailand.
Right.
Or Argentina or something. I don't speak the languages. I don't understand the local cultures. The accounting systems make it different. So I think it's a perfectly reasonable product to use. It's an efficient product in terms of the cost.
Right.
Okay, relative to mutual funds and things like that. But on the other hand, active management has its benefits too if you have good money managers. So
there's still a role for active management.
There's definitely a role for active management. The best, I'm going to share 2 fun statistics to prove that point. And it may shock people. And I do it almost to shock them. In the fourth quarter last year, 37% of the S&P 500 beat the market by more than 10 percentage points. Okay, so if the market was up 10%, 37% of the constituents, so you're almost talking close to 200 names, 186 or 187 names,
right,
beat the market, and they were up at least 20%.
Wow, okay.
If you look at the first quarter performance, 32% of the S&P 500 constituents, so again, another 160 names, beat the market by more than 10 percentage points. And there's this obsession almost with 5 or 10 names that this is all that's all the market.
Right.
No, there's a lot of good stock picking you could have done even if you forgot about those 5, 10 names. So there's always been a role for stock picking. The problem is you have to avoid the losers too, and that's harder. And even if you may have a loser that you couldn't help, right? You bought a stock because you thought the new management that came in was fabulous and they're really, really great and they're going to turn this business around. They've done it before, and you have a lot of faith in this management team. And God forbid, the plane that's carrying the CEO crashes into a mountain.
Yep.
And your whole story just got destroyed. So did this person's family. But I'm saying the notion of you could have done all your research and still had some horrible luck in terms of your stock picking. So I don't sit there glibly saying you have to avoid the losers because sometimes it's out of your control.
Right.
But the notion that stock picking can make a ton of money is still very, very much the case. It's never gone away. It's been one of the best, if you go back decades, it's been one of the best ways to make money is stock picking. So I've always felt there's a role for that, even as we've moved towards more passive vehicles. And for 401ks, again, it's easier for people not to have to sit there and start trying to pick stocks and being that brilliant, because most of us aren't. I'm married 36 years. My wife tells me that pretty regularly. I'm not that bright. She's generally right, but just don't tell my clients.
But by the same token, you in one of the recent pieces that you wrote, you said that we really couldn't hide behind the 401k movement as we might have been able to in 1982.
So what we're really talking about is household equity exposure. So if you look at the Federal Reserve Board data, stuff you're familiar with from your days at the Fed.
Flow funds.
So there's a segment in there looking at the household sector, which is your retail investor, individual investor, but it tends to skew to wealthier people because they're the ones who own the assets.
Right.
That their exposure to equities as a percent of their financial assets are near 50-year highs, if not at 50-year highs right this minute. Stocks have not. We always get data with a lag, which means they're pretty fully invested. So over the past year or so, from the bottoms in March of last year, the equity market globally has added $50 trillion of assets. It's a staggering amount. $1 trillion would be staggering. 50 trillion. You just mind can't comprehend that. But that's bumped up their equity weighting as those stocks appreciated. And they're not devoid of investment participation, right? They're fully invested. In 1982, 83, I think 84 was the low. equity investing as a percent of or equity holdings as a percent of financial assets were really, really low.
Yeah.
So that was an incredibly starting point. As you buy stocks, you bid them up by price, right? Too much demand, not enough supply, price goes up. And that's what they did. And now, if you look at the future based on that, the returns over the next 10 years are unlikely to be that good based on when you've had these kind of levels of investment proportions. So there's arguments that people have to use the 401ks today as a way of building their retirement because you don't have the defined pension program anymore.
Right.
But I could have made the same argument in 1990, and I could have made the same argument in 2000, and we still had some tough years. So I think that argument, people had to do that already 2 decades ago. By the way, it's hard to even think about that for a second. But the tech bubble was more than 20 years ago. So you have a whole new generation of investors, of young people who have no idea it ever happened, right? Because if it didn't happen, if it's not in your memory, it kind of didn't happen.
Well, by that same token, you've got several generations of investors who've never seen rising interest rates.
So that's the biggest debate on the street, okay? Which is, are we going to get inflation? Are we going to get higher interest rates? And I would say there are 3 buckets the way I think about it. Okay. I can't tell you how others do. There's the transitory bucket, kind of the Fed speak. There's the what I call stickier inflation bucket, the one I'm kind of sitting in. And then there's the third one, which is regime change. So what you're talking about a little bit is regime change. The idea of the last 35, 40 years of disinflation since Volcker killed it is going to reverse. And the reason it reverses might be that we go from just-in-time to just-in-case inventory, like we saw with PPE and not being able to get it when we needed it.
Right.
We need more chips, for example. So do we really want to rely on overseas supply chains that might get disrupted? And what people forget is when the Fukushima earthquake and tidal wave hit, it knocked out chip production as well for certain components needed in the auto industry a number of years ago. So do we want to have supply disruptions like that, or do we want something a little bit more domestic, which will be more expensive than if we do it overseas? Workforces here are just a little bit more expensive than those in Sri Lanka. Do we want to have boats, piled up at the port of Los Angeles and wait a month to 6 weeks to have them offloaded? Does that screw us up a little bit in terms of our ability to meet demand? So there's that argument that we might move some stuff back here to have that support. There's a second argument around kind of social justice issues that we need to get more people back to work. And that becomes not just a political dynamic, but it's a real cultural and societal one. So there's this desire to do this, and is there anti-globalization because they're harmed and hollowed out?
Right.
The companies I used to cover back in the Midwest where they moved production, not just necessarily, there's this idea that some of these jobs left Ohio and Michigan, Illinois, and moved to Thailand or Taiwan or whatever, or China, but it's also, a lot of it moved to Tennessee, and it moved to Alabama and Louisiana and all these right-to-work states.
Right.
And
Texas.
Texas at much lower cost, to businesses. When I covered some of these big industrial companies, they were paying $60 an hour, kind of UAW wages. And even if you just graduated from high school, you got a broom, you were being paid that, as opposed to running a machine, as a lathe
low-skilled,
operator.
high-skilled.
Right, didn't matter. And even, so when they started moving those jobs down and opening up facilities in the South, you started seeing the union saying, hey, let's do a double or dual wage system for the new entrants who then earn their way up, which made a lot of sense and was, again, trying to retain the jobs in places like Champaign,
That sounds like a good
Illinois.
way to control your costs.
Corporates were certainly in favor of it, but even the unions understood what was happening and said, we want to maintain these plants in places like, Elgin, Indiana, and Champaign, Illinois, and stuff like that. So we didn't want it all going down, to Asheville, right? And as a result, I think there's a tendency to think it's all offshoring. That wasn't necessarily the case.
Right.
And again, I used to cover industrial companies, so it's an area that I have a lot of passion about, a lot of strong feelings on. But even outsourcing the way we think about it and how we lost all these manufacturing jobs. Well, if one of these manufacturing entities decided to move their payroll system to somebody like Paychex or something, and you take care of it for us because you have efficiencies that we don't have in terms of scale, those left an SIC code that was manufacturing and went to services, even though they were doing the same services job. So some of the job losses, even McKinsey's done work on this and guys like that, trying to understand how much really got offshored, how much got onshored and how much got, moved to, again,
Well, there's
more
also
efficient systems.
there's also automation.
Yeah.
It's revolutionized a lot of areas of industrial.
Think of it this way. To me, the simplest way to think about automation, we don't have to get really cool and technical and robots and all that kind of stuff. You have an answering machine that answers your phone, right? If somebody calls you on your iPhone, it goes to your voicemail. There isn't a secretary taking your message. And you want to talk about the substitution of capital for labor? That's about as simple as it gets. And it happens in so many other ways. But I'm saying that just knocked out.
Well, I mean, now if I want to watch a movie, I just look at the movie on Amazon, search for it, and download it. I mean, I used to have to.
Oh, you got to get the new remotes that you talk to. You don't even have to search.
There's a remote I can talk to?
Yeah, there's some remotes you can talk to now, right? And just say, I want to see X movie, and it'll find it for you, and it'll come back and say it's on. If you have Amazon Prime and it's free, go for it. If you want to pay more, Hulu will charge you. You have those
So I thought
options.
I was going to walk away with the 9 components of the panic euphoria model. Instead, I'm going to go find this remote control. But
I've seen it advertised. I don't own it either.
But my point is now people are, a teenager is like, what's a VCR?
Just keep in mind that I was the family remote control. Okay, because I was the youngest, so my brother or my sister or my parents said, go turn the channel, and you have to go and turn the channel. So I was the human.
Yep.
I was the bot well before they came out with the device.
We had a TV when I was growing up that was in one of those wooden cases. It looked like furniture. For heaven's
Hey, I
sake.
still remember when we got our first color TV. It was like, yes, we're cool.
I remember, I guess I'm aging myself, but yeah, I remember
I think I
black
was
and
12.
white.
I think it was like 1973.
Mighty Mouse. I always woke up like at 5:30 in the morning on Saturdays, and my parents were always like, "Go turn on Mighty Mouse, and watch the black and
And they
white."
go back to sleep.
And then they go back to sleep. Exactly. But back to the 401k thing.
So I don't think again, because asset prices have gone up so much, 401ks for those who haven't have ballooned.
Mm-hmm.
For those who haven't, I worry about them in terms of where we are in 20, 30 years. You can see the stats. That's what the average person has.
I'm kind of shocked at what a lot of baby boomers don't have.
Yeah, no, look, I guess my dad taught me a long time ago, that you got to save your money. You can't just spend it. So
that's the one thing I keep trying to tell younger people is that they want the get rich quick. They believe that they're pretty assertive on my Twitter feed, but I'm like, no, you have to save the money first. First, you got to save the money.
It's hard because there are a lot of reasons why it's hard. We live in an instant gratification society is part of the problem.
Mm-hmm.
Again, I'm as guilty as anybody else of that. You don't get a body like this by chance. You have to work at it. So if there's that burger there and that piece of chocolate cheesecake, it kind of gets eaten.
So back to your 3 buckets of inflation.
So the first bucket we're talking about, which was the Federal Reserve Board's kind of transitory, transient kind of thing. I believe investors, when they hear adjectives, they put numbers to it. So if a corporate management team were to say in a conference call, our business is up slightly, right? You kind of say it's up 1-2%.
Mm-hmm.
And they say modestly up 3-4. If they say moderately mid-single digits, if they significantly, you're probably hitting double digits, right? They don't say that, but we attribute numbers to those words. So when you hear the words transitory, I think for most investors, the thing is several months.
Yeah.
And it goes away. And part of that is the pandemic-related base effects start to moderate, right? So your year-over-year jumps in inflation will start to slip.
Theoretically, that starts in June.
Right.
With the June data, I should say.
So I'm saying that, which means you get it in July, right? So it's several months and then it dissipates. The problem is that some of the issues that we're talking about in terms of, you mentioned chips before.
Mm-hmm.
So those chip shortages, the idea of labor costs. So if you look at the National Federation of Independent Business, their biggest problem is quality of labor.
Yeah.
They don't have the right fits for the people. It's not, this whole discussion around, is it the enhanced unemployment check keeping people out of work? I'm sure there's some people doing that, but not generally. There's some people who are fearful of COVID and going back and getting sick. There's an answer to that called get vaccinated, but whatever.
Right.
And there's a third one, which is women who can't get their kids back to school.
Mm-hmm.
And that's a huge number.
Yeah.
And, in that sense, they want schools open so they can get back to work. It's not they don't want to come back to work. But again, that might have been a cashier at a store that's no longer reopening. and then don't have the skill set to operate a machine shop, work in a lathe in a machine shop in Waterloo, Iowa, or work in coding in Silicon Valley, or drive a truck, with a big rig. They cannot work on a construction site. You really want people who are untrained to be, on an infrastructure site with a jackhammer? Probably take their foot off. So, we have skills mismatches too.
And we've had a skills mismatch for a long time, but I feel like the
Seems
pandemic
like it's getting exacerbated.
Yeah, and now we have countless brick and mortar employees with retail sales experience, and that's about it.
Look, it's not. If some of the retail sales experience can go to work in a hotel pretty easily, and stand behind a desk and say, "Can I check you in,
right,
Mr. and Mrs. O?" I mean, you don't need to be a skilled, operator of a machine tool.
Mm-hmm.
To do, that's a different kind of skill set. It's like, welding is a really high end skill set. Welders make a lot of money.
I know they do.
And you wouldn't want to give me one of those torches. I'd burn a body part off.
My old boss, Richard Fisher, that was his favorite example. Welders.
It's really underwater welders. The guys who fix pipelines off the Gulf Coast, they make these. So these are Navy frogmen, former Navy frogmen who learn how to weld, and they get paid, 6 figures.
Wow.
Usually starting with a 3 or a 4, because it's really dangerous to go after a hurricane under there and try to reconnect those gas lines.
I know where I'm going to send my kids.
It's. I mean, I shouldn't. I'm going to say, because I often say things I shouldn't say. But I used to tell my son, who's got a doctorate in psychology, that he should become a plumber. And my wife says, "Why'd you tell him to do that?" And I said, "Because I think he'll make more money cleaning the crap out of people's toilets than out of their brains." But I say that as a joke, but I'm not actually joking.
No, if you think about the average age of an electrician in this country, when I was in high school, there were the guys in shop. There was shop.
Right.
Try and find shop in a high school today.
No, they're probably doing programming somewhere, coding, which is fine. There's nothing wrong with that. But we don't have mechanics. We don't have electricians. We don't have plumbers. And you try getting a contractor to show up when they say they're going to show up at your home. So these are really good jobs, get paid really well, but we have a lot of people who don't have those skills. So the skill set issue is a real problem, and we're going to spend money on training. We're going to have to get people there, but that doesn't get resolved overnight.
No,
that
takes a generation.
I'm saying we can't remedy some of the issues. So I was talking about the NFIB data. Historically, when the NFIB is telling us, small business people are telling us that quality of labor is a big problem, within 6 to 12 months, you have significant wage increases.
Mm-hmm.
So I'm hearing it. Now, I was talking to somebody recently, the family office, that they own a bunch of hotels, and they need to fill 200 jobs and offering $1,000 signing bonuses, and only 3 people signed.
Yeah.
Right. They're people trying to find, home builders are trying to find people to work on their sites to put up new homes, because we have a severe shortage of them.
Yep.
We don't have the people; they're not available. So I think these are issues that aren't transitory. They could stick around for 9 to 12 months. If you need copper, it'll take 3 years to put up a new copper mine.
Mm-hmm.
So these supply issues don't get resolved as quickly, and that's why I call them sticky. Now, you might sit there in 9 months and say, we're going to replace copper with plastic or aluminum or something like that in that specific application.
Yeah.
You might say, I'm going to bring on some robots if I don't have enough people. But again, this is not something business can do literally overnight.
Yeah, I read a headline that a major manufacturer was closing a plant and moving it to Mexico. That was the first time I'd seen one of those headlines in a long time.
Having been an industrials analyst years ago, the quality of labor and product out of Mexico has not been as good as the quality. They would always have to bring it back and redo it.
Mm-hmm.
And so we'll see. Look, there are a number of great maquiladoras that probably do fantastic work, but I just remember that my experience is kicking up and saying, "Ooh, that didn't work out so well last time."
So wage inflation, that's a big boogeyman
it's
at the Fed.
60% of corporate cost.
Yeah,
that's what we have to remember. If your transportation costs went up to deliver something, and maybe it was cost you 3% more, it's one thing. But if it's 60% of your cost going up, you need to do something about it. So either we're going to get some pressure to raise prices,
mm-hmm.
and the other one would be if you're not able to do so, then you're getting a corporate profit margin pressure.
Well, there's the issue of pricing power, right?
Yep. So some companies have them, some companies don't. And the ones that don't are going to have to be really, really creative, or their margins will suffer. So it's kind of a tug of war. Are you going to get some inflation, or are you going to get some
margin compression?
Margin compression, right? It's one of the two. There's not kind of this easy, narrow path in between. And I'm very happy to not work for the Fed, because I think navigating this path is going to be very difficult. Everybody loves you when you're adding, boost to the punch bowl. They don't like you when you take away the punch bowl.
No, I mean, just the very idea. I mean, one CPI print, and we all lost our minds.
And people were worried about the CPI print. They knew that it was going to be bad, and it still shook them. What if it's shaking them in August and September?
And that's a whole different issue.
I think the bond market may test the Fed kind of like they did in February and March. If there's again, I'm not talking about regime change, but I am talking about a little bit more persistent, stickier inflation than transitory, transient.
So what can the Fed do? I mean, housing is an issue right now.
Look, the Fed's a bit boxed in, I think is the best way. And people have said that. They put themselves in a kind of an uncomfortable situation. Mm-hmm. And now they have to kind of, I don't know if it's hope and pray, because it's too strong a term, but they better be right, or they're going to get egg on their face. And egg on the central bank's face, the most important central bank in the world, isn't the best thing for us.
No. And it's interesting to me that that the whole financial stability issue has come to the forefront in Fed speak so quickly. And now the ECB is kind of echoing the same. Which is actually, I'll give them credit for that, for even bringing it up. Leo Brenner brought it up in the report, but it's usually too late, though. I understand that, but they tried to avoid all of that in 99, 2000. They just didn't talk about it. You had the original irrational exuberance statement in 96. That was the Greenspan era. Right, that was 96, right? It was way ahead of its time. Yep. And then that was it. And then margin debt took off. No, I'm saying, but then when you got to 99.com frenzy, mm-hmm. nary a word from the Fed on this. So I give them a little bit of credit. At least they want to be on the right side of it in case mm-hmm. something bad happens. We talked about it. If you paid attention or not is your issue, but we at least mentioned it. Mm-hmm. They're not going to mention a lot, but they'll at least get some credit for that. But it's also interesting to see, I'll say Chair Yellen, Treasury Secretary Yellen almost make a chair statement. Oh, that was, and then pull it back a bit, and then you saw the Fed said, in the minutes, the commentary around if things get stronger, then we would have to react in the interest rate environment, and it's like big duh, like of course that's part of your mandate. So, but it was interesting that they're willing to even have that show up in print. Yeah. Like they're aware that this is a potential problem, even if they don't think it's going to be a problem. Well, and they're starting to talk about housing a little bit more. So you can almost imagine that, people don't realize that it's $40 billion a month of mortgage-backed securities, but prepayments have been insane. Mm-hmm. So you might have months when the Fed is buying 3 times that amount in the mortgage-backed securities market just to reinvest, just to keep the stock of mortgages where they are. And it's just a huge influence right now. And yet, but they always do that. I mean, I'm less, people talk about the Fed's manipulating the markets, right? I've heard that comment, and that's their job. They're allowed, if things get stuck in the markets, the Fed comes in with a crowbar and kind of gets it unstuck. That's mm-hmm. that's part of their job. Again, if you and I do it, we go to jail. But I don't really have a problem with that. I think that is their charge. I think the debate is, have they gone too far? Okay, and I'm going to leave it to my fixed income strategists to talk about. They're far more knowledgeable and probably even more eloquent about it than I'm ever going to be. So I'm going to keep my mouth shut for once. So, but you can speak to balance sheets. And we know that the Fed came riding to the rescue of the corporate bond market. And they should have. Look, and they should have when everything froze. Again, this is my point about the crowbar. When everything kind of really got out of whack in
March.
So you don't think QE alone would have done it? I mean, they were buying $100 billion a day on some days.
So when I've talked to former central bankers, who I respect significantly, I've heard them talk about and giving me different dates in history where the central banks have gotten involved to fix problems. That sometimes the traditional metrics don't work, and you got to be. That's why I was using the term crowbar. You really have to force it, because everyone's too scared to let the markets function properly. And they are, in that sense, the buyer of last resort. And once they stabilize, they should be pulling back and let markets do their thing. And that's where I think the debate is. Have they overstayed their welcome? And if they then have to pull back, do they cause a problem that they tried to avoid? And we'll see. Time will tell.
One of the most insightful comments I've heard recently is that we are existing at either end of the distribution, that we live at the tails right now. And that's kind of what you said.
Is that so bad? Let me put it this way. So most businesses and certainly financial institutions have this wonderful thing called Vars, right? Variability risk, right? And those tend to be in the tails. The stuff that you deal with, the 95% of the two standard deviation type stuff, that's normal. That's not where you have the problem. It's when you're in the tails that you have the problem. So I always laugh when they do the Vars, because they do it 95% probability. Your problem isn't the 95%. Your problem is the 2.5% on the ends. And therefore, I never quite understood that kind of risk profile. So I'm not so sure it's that bad that we're living a little bit in those edges, because that's where the problems tend to be.
So talk a little bit about the prospect for earnings growth going forward.
So it should be really good.
That's what we're all expecting.
It should be, because the economy is getting better. Companies have learned how to be efficient, all those kind of things. We saw the first quarter blast through expectations. I mean, there's beating expectations, and then there's beating it by $7. Okay, more than $7 actually. But
you can set the bar pretty low.
Which companies did? You always hate when you listen to a management team talk about being, the cringeworthy, cautiously optimistic terminology, and they kind of sandbagged. But nonetheless, they weren't sure either, to give them some cover.
There was huge uncertainty. I agreed.
But now I think that there's a change in that expectation. Now every quarter should be a blowout. Is kind of what ends up happening in the mindset of investors.
Right.
And there's kind of published estimates, and then there's kind of in your mind estimates that are generally above published estimates if you just crash through them.
We used to call it the whisper number.
Yeah, we're not allowed to. Our lawyers get crazy when we say that.
Okay.
So hence I'm talking about the unpublished expectations and not using that particular term. I'm very adroit at avoiding the words that are going to get me into trouble. And in that sense, I think the street is anticipating even better numbers. So we think the market levels would argue for like $190 in earnings for the S&P 500 already is the expectation built into the market, when street consensus is more like 183, 184. So the market's already pricing in better numbers. And they were doing that before. And again, we crashed through the numbers. And if you and I were talking a month ago, the numbers are probably more like 171, 172,
right? Not
183, 84. And again, $7 of that is just the first quarter catch-up.
But don't you think we're going to start to see the effect of some of these rising costs?
Yes. So that was a time of the margin pressure. Even if businesses raise prices, some of the stuff that's going to go through the revenue lines in the next quarter or two is stuff you already booked before at lower prices. That are kind of price protected.
Yep.
Okay. And as a result, the increased costs to the business will show up in costs, but the revenues won't carry the higher prices. Maybe a couple of quarters from now, that which goes through the revenue line is at the higher priced item, but not initially. So we could get some disappointment on the margins on that front from our perspective. I mean, look, again, I can look from personal experience. My wife and I ordered a new wooden door for our front door 6 months ago. I think we're getting it next week. Gosh. So we don't have to pay more because we paid for it 6 months ago, but we're paying a different way in terms of when it gets delivered.
Of course.
Right. And that's the world we're in. I mean, there's shortages everywhere. I have a friend who's bought up a bunch of gyms in Florida and wants to open up a chain of new gyms as everything reopens. He can't get equipment. Backlogs on bikes, on treadmills, on weights, everything, benches.
You bring up fitness centers, and I'm going to have a non sequitur. What is your feeling about, not anyone in particular, of course, but what's your feeling about SPACs and cryptos? And
so, our panic euphoria model is in euphoric territory. It measures sentiment, and I think some of the stuff you've seen around meme stocks, around the SPACs, around crypto is just lots of liquidity sloshing around looking for a place to go. And again, in this kind of environment, speculative activity can occur. Mm-hmm. It's not that, look, SPACs themselves are not inherently bad concepts.
They've been around for a long time.
Right. And the idea of giving smart people money to invest in businesses that either turn around or grow faster because they have good management skills is all fine. It's when you have over 400 of them hitting the market at the same time. Movie
stars and sports legends.
Well, the celebrity SPACs are kind of an interesting dynamic. They amuse me more than anything else. People buy it. Oh, I got to hang out with so and so.
Yeah,
right?
Yeah.
I get to hang out with Danielle, so it's all good. But but I think that the notion of money going to areas that probably they shouldn't go into because they don't really understand them is worrisome. Okay, and I'm asked a lot about this stuff. I have a 94-year-old father who loves to invest. And he always asks me questions about some of these things. And I no matter how much I try to deter him from doing these things, he does some of these things.
Well, he's 94.
Yeah, it's fun. This is fun. Thank God his brains function and his body functions well. And we should all have his health at 94. But I worry about, again, these are areas he's totally inexperienced about and is willing to kind of risk some stuff. And I tell him, Dad, just don't do it. And he goes, why? And I said, because I'd like to have an inheritance, when you go. And
tell me how you really feel.
I know. He laughs. He gets the joke. But it's to me, it's just a reflection of the sentiment. I'm looking for my get rich quick scheme.
Yeah, I have a lot of people on my Twitter feed who call me a boomer, which I'm not.
Hey, boomer.
Hey, boomer. Hey, boomer. Don't you know you don't need to work? I mean, this is common.
That's why I enjoy listening to my children complain about if I understand how much diapers cost and how much kids' clothes cost because they grow out of them in about 4 minutes. And, we're working and we're trying to keep up, Dad. And it's like killing us. And I'm just sitting there smiling. What's so funny? I said, maybe you'll appreciate your parents for once. But they do learn it as it's when you're 20, you want to live in Manhattan because you want to go party and order Chinese food at 3 a.m. And when you have kids at 3 a.m, all you want is those kids to sleep and not be woken up by the fire truck going down the street, the police car going down, the garbage truck going down the street. Mom and Dad weren't idiots living in suburbia. And guess where my kids live now? Suburbia, because they want their kids to sleep.
Yeah. No, I mean, I can't tell you how many friends in the city who haven't been in the city.
You just get older and you more wiser and more experienced, and there's something to that. I was watching a Bill Maher thing about, that when people say, hey, boomer and all that, he says, like, people, if you learn something new every day and you've lived 10,000 more days than the other person, probably there's some wisdom there.
There should be.
And I think he did this whole thing on 18 to 34-year-olds as the prime advertising cohort. And he says, you know why? Because they're the most gullible people on the planet, was his term. And I kind of enjoyed that. It's like, Bill's making a lot more sense to me almost every day.
So you can't turn Bubble Vision off of mute without hearing cash on the sidelines. It is, and it tends, at least in my experience, you tend to hear it increasingly at kind of an inflection point because people are looking for a reason they're looking for a defense.
Well, it's more than that. I own it and I want you to buy me at a higher price. So you need that cash on the sidelines to be that next buyer.
But isn't there always cash on the sidelines?
True. And the numbers that people cite are actually wrong. Okay, so what they typically cite is money market funds, retail money market funds in particular.
Okay.
And it could be institutional money market funds too. Those corporates have money that they can invest as well, and they can buy back stock. But if you look at the household deposits numbers in the flow of funds data of the Fed,
Wow.
then the numbers explode. You're at like $16 trillion of quote unquote cash. But a lot of cash is grandma's passbook savings account that's never coming into the market because grandma's 83. And when grandma loses money, she can't get another job right now and start earning to make up for the losses. So there are people who aren't ever going to put that money in. And that's why some of the cash on the sidelines never enters the market.
Yeah. And the Fed has very good data that shows demographically that, it's between 55 and 64 and 65 and 74, that's where the bulk of the savings exists.
Right.
And including the Delta.
And it's not even that different if you go to Japan. Again, the money tends to go to the elderly.
Yeah.
And the young people aren't as wealthy. But I think that's generally true because as you're young, you're not making as much money and you need that money to pay for your rent and all that kind of stuff. And as you move up in life, you can hopefully get ahead of that and put some money away. But the notion of that money also being there is pretty interesting because that generation will die out.
Well, that's my next question. I mean,
we're going to have this massive intergenerational transfer of wealth in the next decade or two.
Or at least you're hoping.
I'm
kidding. No, I'm kidding. I'm kidding.
My brother and my sister, maybe. I'm not. I'm pretty sure they won't say this. But the idea of that intergenerational transfer of wealth, when people worry about where the young people's savings are going to be, it'll probably be inheriting their parents' wealth. And again, it may not be that the mom and dad had this huge portfolio. The mom and dad lived in a house.
Right.
And that house has appreciated over the last, 30, 40 years. And when they get sold, it's worth, they bought it for $50,000. Now it's worth $300,000, $400,000. Right. And that's a lot of money.
I read a statistic that since the pandemic, retirees have actually traded up to bigger homes. 30% of them. It was a big survey that was taken. But retirees in general aren't flowing into retirement homes as they did generations ago. They're aging in place.
Look, the good news is on the health front. There's a lot of bad news on the health front, particularly the pandemic. There's also the good news is longevity's increased. People can live their pretty good lives even after they retire. It's not like you're working next day, you're in the rocking chair, can't remember anybody's name. It doesn't kind of work that way. And so a lot of them they're more travel, and they may not be spending more on clothing, on furnishing, but they might want to go on a trip somewhere. And it's just different. They're going to experiences.
Especially domestically.
Right now, yeah, because it's kind of hard to get away. But I'm talking about over the last 10 years, not the most recent year. And they actually have something very much in common with the millennials, is they both want experiences.
Mm-hmm.
So what's interesting also is looking at the baby boomers who are retiring, and they're in most cases millennial grandchildren or grandchildren,
mm-hmm.
that they have this kind of connection about experiences, that they'd rather spend their money on experiences.
Mm-hmm.
So a lot more travel, family trips. You hear a lot about these kind of fun things, and that's fine. I mean, they'll still spend money, but typically older people don't spend as much money as they were when they were younger, and therefore there'll be more money to transfer to the next generation over time, so it doesn't get taxed away.
Taxes. Given the concentration of stocks in the hands of older investors, that is pretty unprecedented. I mean, in terms of the concentrated, will capital gains taxes matter?
Depends where they go. I think there are people worried if they go to full ordinary income, that it could have some negative implications. You might want to sell early just to lock it in at a lower tax rate, or it depends again if it's grandfathered to January 1 or not. And there's going to be all these kind of interesting elements that we still have to deal with. If it goes to 20 to 30%, probably less of a problem. So we just don't know the details yet. It will stop all kinds of innovation, probably not either. But at the margin, it should hurt because tax policy does impact the way people think about their activity. I would say the bigger question is the step up. If I bought my portfolio 20 years ago and then I died, I leave it to my kids, and there's a step up in the value, and that changes. That could be pretty significant, and people will make adjustments. I was listening to a conversation about coming from the White House about this would be really, really good for charities because people will donate tons of money to charity because they'd rather give it to the charity and get their name on the wall kind of thing rather than give it to the government, right? And
get the tax deduction.
Right. So I was thinking about that, and there's more stream of consciousness. I said, I'm not so sure that's the way it's going to play out. I think if you're really, really wealthy and you're giving billions of dollars away, you'll probably create foundations. Yeah. Right. And that's what give it directly.
We've seen that happen. I'm talking about generations. Way back. But we saw that happen.
Right. And Carnegie Foundation,
the Ford Foundation. All
these foundations were found. The only difference is now you're going to hire your kids to run those foundations and pay them millions of dollars. I'll transfer the money to them, but I'll just do it a different way. So I think people will be very clever about that. And the foundations, every expense that the family has will be on the foundation. When you have to go to that gala, it's amazing how you have to take a private jet and things like that. People will be, they're creative, clever, they're creative, and the laws don't preclude it.
No. So, I think the CPA community right now is like, yay, the tax code's about to get even more complicated.
And there'll be new tax shelters that are created out of the loopholes that exist in the next piece of legislation.
Yep.
There always is. That's the one thing I would really be upset about is that we spend all this creative activity on tax shelters. It just seems like a waste of, really good brain power.
Yeah, it's a waste of, my mother always said, if you want earnings capacity for the rest of your life, become a tax attorney. She's like, you got job security forever.
Just remember, a lot of congressmen and women and senators are attorneys, and what do they do when they leave Congress? Become partners at law firms.
Yeah.
So, you just have to think about what people do.
True enough. That whole running for politics.
There's another really good benefit of being a congressman or a senator, which is you get, serve one term and you get healthcare for life. Not bad.
Go Pat Toomey, Mr. Term Limits. So, winding down our talk, obviously the Federal Reserve was a huge influence in my career, and it changed the way that I see the world. It had to, after nearly a decade. But how has Fed policy in the past 20 years changed the way that you kind of model, changed the way you forecast?
Not a ton. And I know that sounds crazy when I say it, but you care about interest rate levels and you care about things like that in terms of activity.
But quantitative easing.
Right. No. But so you look at funding costs as an important element to return on investment. And what all it does is it lowers the bar so that things that might not have made sense in the past make more sense to invest in today because you don't need to generate the same kind of return. Right. If my funding cost was 10%, I need to make 20%. If it's 5%, maybe I only need to take 10%. If it's 2%, maybe I only need to make 5%. And it makes you willing to take on lesser return because it's still better than the fund than what other people could put their money on. And I've seen that even with real estate investing, where people would demand kind of high teen-like returns for the risk you were taking and the liquidity of that. Right. Today, they're generating 6-7%, and it's fine.
The crashing cap rates.
Right. They're willing to do it because that's a great return relative to what I'm making elsewhere. So that's all it does is it forces new investment into other areas and potentially into speculative activity.
Right.
Because you're not getting a decent enough return to sit in cash. So you're willing to try a few things and take, basically you're doing the long bomb and you're hoping. It's a Hail Mary.
You look at defined benefits. They're increasingly in private equity and very aggressive.
It's not even. I sit on an endowment board, and we have to think about how we invest money for the institution, and to me that was like a great experience because it's not something I ever have to do before. So joining that has been a really good exercise and learning for me. And what private equity does and what venture capital does and things like that is it can create much greater returns. It does mathematically, but there's a liquidity dynamic to it or an illiquidity dynamic to it.
Sure.
There's positives and they can get day-to-day mark-to-markets. And there are negatives in that if you ever needed that money immediately, you couldn't get it.
Right.
So you have to measure in your investment portfolio how you want to think about return against availability. And you structure your portfolio differently a little bit for that. And I think maybe that's where it would, where the Fed policy changes force you into different kinds of instruments.
Right. I'd like to take grandma to Vegas, get her some junk bonds. But so I have one final burning question. Which is better, being a father or being a grandfather?
Oh, grandfather, no question. My kids.
And you've got
I have five, and I can't make most of the jokes because they're inappropriate. But I am going to tell you this one where. So my wife and I decided, and it just ended up working out well for the pandemic period. But we decided in October of 2019 to put in a pool in our backyard, and the rationale for that was really the grandkids would come over a lot.
Yeah.
Right, because they'd always want to play in the pool, and even if they got older, they even get into teenagers. Say, "Hey, grandpa, can we bring our friends over?" And they don't care. Sure, as long as they get to see our granddaughter at that point. When they're teenagers, they don't care about the adults around them.
Yep.
But we'll get to see them because they'll bring over their friends, right? And I actually I told my wife when they're teenagers, I'm putting like a microphone out there so we can listen to their conversations. That'll be fun. But
you're giving me ideas, Tobias. I've got teenagers.
It's a fun concept. She shot it down. Something about privacy invasion and stuff like that. I don't get it. Why tech companies don't have to do it? Why do I? But so we decided to put this in, and it just so happened that the pandemic hit.
Right. You beat the pool rush.
So my kids were saying, like, we didn't get the pool. How come? Why are you putting it now? I said, for grandkids. I said, wait a minute, you love them more than us? Kind of.
Well, you get to send them back.
Well, they become a pain in the butt. So I will. Let's do this. I'll leave yours with a cute joke that somebody told me a long time ago. It's clean, don't worry. Which is, well, you'll get it. If you ever notice baby diapers go under the brand names of Pampers, Loves, Huggies, but the adult incontinence products go under the name Depends. They serve the exact same purpose. So what's the deal? So somebody explained to me very clearly, if a baby soils themselves, that's the dirty part. And you have to clean them up, and then you re-diaper them, and you still will hug them, you'll still pamper them, you'll still love them. But if it's an adult, it really depends if you're in the will.
Well, okay.
Not sure that's the exact note we want to end off on, but
no,
it's still
that's
cute.
the note. I'll never look at depends again and not think depends on if I'm in the will. Sir, thank you. You've taken so much of your time.
Thank you.
It was great visiting, and I hope we do it again in a year, and maybe there'll be a sixth grandchild. We'll see.
Maybe. I want my son to get married first, though. There's a sequence that I prefer.
Thank you, Tobias. Thank you very much.
Care.
Well, like I said at the beginning of speaking with Tobias, that's about as close to an exclusive as we could possibly have gotten for Down the Middle. You've seen him on CNBC, you've seen him on Bloomberg, but in terms of sitting down with him for more than an hour, what a treat. I really, really hope that you enjoyed the time with Tobias Levkovich. Please understand that it was a great privilege for me. And obviously, hopefully, it was a great treat for you as well, one of the best thinkers on Wall Street. Until next time, this is Danielle DiMartino Booth for Down the Middle. And don't forget, if you haven't subscribed, please do so now.